Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 16th, 2022. It is 10:17 Eastern Time as I'm starting the video. I'm going to do something a little bit different in this one. We are going to cover some of the recently highlighted trade ideas, primarily the equity markets and energy sector. But what I want to do is talk a little bit more. I do that day after day, and I'm sure it's a little bit monotonous to some of you guys looking, talking about, support levels, trend lines, projections on where things might be going. But today what I want to talk about are three main things, and I do always integrate these from time to time into the videos, but the keys are diversification. In other words, the same rules that hold true to investing. Don't put all your eggs in one basket. Absolutely hold true to trading, at least in my opinion. Then flexibility. I'll talk on that as well. In other words, the ability to adapt and recognize when something changes, so therefore change your trading plan or what you think may happen and how you react to it. And that is ever so important in a market like this, a fast moving market where both the technicals, the charts, not just the daily swings of 3% or more in the broad markets, natural gas doing its thing up one day 15%, down the next 15%, things like that. And then finally, position sizing. I'll talk on that as well. It's one thing to be diversified, but position sizing is very important as well. And let me just get that one out of the way now. What I mean by that is, okay, so natural gas, I just used that example. There we go. I flipped over to the chart of natural gas I had on NQ a second ago. This is NG, natural gas futures. This is a security that regularly moves in single day double digits, 10% or more regularly. Not every day, but quite often. It's more the norm than the exception. All right, so okay, on that one. So we're talking about diversification. So let's just say you're like me right now. You have treasury bonds, you have some precious metals, you have energy stocks. Within the energy sector, you have coal, oil and gas, as well as natural gas, or the commodities themselves. Crude oil and natural gas, or the companies that produce those. And so that is in itself diversification. However, if you have, let's just simplify this example. Let's say you have half your money in the indexes. Long or short doesn't matter. Let's just say it's QQQ, right? And then the other half you're bearish on natural gas, and you have 50% of your money there. Again, that's going to hurt you, because those days that the natural gas trade moves against you, 15% or more, you're going to feel a lot of pain. You're probably going to be stopped out. Your portfolio is going to take a huge hit. So therefore, I made up years ago the term beta adjusted position sizing. You can check in the FAQ section. I define that as, take a position size. I even made a calculator. It's on the site also under the resources page up at the top. And it'll basically, the more volatile an investment is, then the smaller your position needs to be. So with that being said, so let's just use that number. These are ballpark numbers. So natural gas in a good or bad day is going to go up about 15%. I've seen it go up more. I've seen it do 20, but let's just say 15%. That's usually about pretty much extreme. In the equity markets, we've seen this lately. It's close to 5%. In a good or bad day, it's usually around 4. So therefore, that tells you right away a QQQ or NQ position or whatever it is. But you have to factor in. Let's not talk futures, because then because then you bring in leverage factors. So let's just say a pure play like QQQ for the Nasdaq 100, or UNG, which is the non-leveraged one-time natural gas ETN. It's going to go up and down with in percentage terms. So therefore, by that logic, you're talking have about a third, maybe even less, in your natural gas position, all other things being equal. Now that position can be over or underweighted depending how confident you are on the trade, on the risk reward profile. Sometimes, for example, had I woke up from a coma today and seen this chart, this pushback I told you yesterday, that would be a very nice objective short entry. Doesn't guarantee we're going to fail there, but this is where, if I had zero position, I'd go in heavy. And I most certainly added there today, because I mentioned to me, that's a very significant technical level. That's a pretty nice retracement so far off that big drop. Bear flag thing never played out, but that doesn't matter. It never played out, so it never even triggered an additional sell signal. So therefore, had you already been short or wanting to get short, you never even, you didn't go there. So it's a good thing. Now you have a better entry price. So there's an example where you might go, pretty heavy, and you can keep, again, there's a million and one ways to trade. A very tight stop would be somewhat above there. Somewhat is also relative to that position size. Okay, somewhat on Treasury bond futures or Treasury bonds (TLT). Somewhat a relatively tight stop might be 1-2%, right, on government bonds. A relatively tight stop on natural gas should be at least 5%. Anything less, you're going to get clipped out. This thing is so volatile, it'll pop, stops briefly. And so because of that volatility, again, if you're taking down your position size, if you might trade, again, your number is different. Everyone's just put this in relative terms, 100,000 in Treasury bonds, then you might only want to put 20,000 or less in natural gas. Therefore, a 8%, let's just say stop loss on natural gas on a $20,000 position is going to be comparable to a, what is it, if you have 100,000 and, that's 5 times higher. So you take that down, gives you about that, 2% or so, 1% stop. All right, so I think you get that point. That's critical to trading, investing. If not, you're going to have over time, even your most favorite positions are going to hurt you. They are not your friends, your spouse, your children, family, friends. It's the market, and it's not personal, but there are going to be things that take a great looking trade with the best technicals or the best fundamentals, and all of a sudden, boom, trade long enough and you'll see that happens too, and therefore position sizing. All right, flexibility. Let's talk on flexibility. Going backwards here, but that was I'm going to start out with that NQ chart. Okay, so I got a post out to you this morning showing you what happened last night with the futures. So I'm trying to find that. Bear with me here. NQ, there we go. Okay, this is a 60-minute chart of NQ, and I'm zoomed in. This is just 1 month of trading history. Quite often I'll go out to 3 months, but if I don't make mention, you can always see up here. So we have hourly candles right there. That means 60-minute chart, 60-minute candles, and 1 month of trading history. So here's what happened. Recently we put in this small divergent low, right? And this is all, and keep in mind, and I probably should have made a better point of impressing this upon you guys yesterday, especially those of you new to trading. This is all pre and post FOMC noise, I call it. And we're still in the wake of the FOMC meeting. Remember, that it can take a little while, a couple days sometimes, for the market to decide which way it wants to go. So we're talking about flexibility here. So first of all, and one other takeaway, why I'm sharing a lot of just kind of general trading tips in this video, is the reason that I like futures. I told you yesterday that was long. I was going to try to swing some up, but that was an objective stop level right under that trend line. We had a nice short-term trend line, and that happened right around midnight. That was the 1 a.m. candle that was finalized. So we broke it around midnight, and then by the end of that 60-minute candle, we had a solid and impulsive breakdown of that cleanup trend line. The only whipsaw, and that was just this little part is a shadow, or the tail, the skinny part of the candle. So you have numerous, you can zoom in tight and see it, a lot of touches there. So it was a well-watched trend line. It was also on the futures, and this is again why I say even if you don't trade futures, you don't have the money because they take, they're leveraged. And there's also mini contracts. You can go MNQ if you want to get your feet wet. Again, I don't have any vested interest. I'm not promoting futures because, I have a deal with the exchange or not. It's just what I've evolved over the years to trade because of this. Because MQ, or NQ, this is the same thing. Trades on the same price levels, by the way. MNQ, just a smaller leverage factor. That stop would have got taken you out at right around midnight. And in QQQ, well, we opened up down here. Remember, we were flagging this morning. The futures were flagging. This is where QQQ was. So by doing that, there was no possible way in QQQ, because it's not trading at midnight. The post market session's over. This is where it opened up, down almost 3%. So that is a gap down, and that is the risk that you have with ETFs and things that don't trade around the clock like the futures. So all right, and then you can see here, it's just a textbook, and lately Remember, we're in a bear market. We're in or at least a primary downtrend, however you want to define it. Forget about the semantics of whether it's a bear market or correction. Um, we're certainly in a larger downtrend. The Nasdaq 100 has been since November, and it's at new lows now. So there's your bear flag. There's your impulsive breakdown. Now let's talk about being flexible. Okay. Um, the markets are full of trickery, if you will, from to a larger or lesser degree, the big institutions, big money, trading desks, huge, hedge funds and other trading trade desks with running algorithmic programs that sniff out stop areas to clear and raid those stops. They have a large enough amount of money they can buy enough futures contracts or enough of a single stock or commodity to bring it down, especially in the short term. And that's what they tend to do. So therefore, you have to acknowledge that. And sometimes the best-looking breakdown, such as this bear flag I point out to you this morning, which at the time hadn't broken, but it since has, that could be foiled. And here's the thing, too. More so, I would feel a little bit comfortable. I'm driving, with one foot, again, as I often say, one foot on the gas, one on the brake right now with shorts, because we broke down. That gave us a sell signal. We also took out the recent low. So from, if you just want to keep it on face value, which I'm doing now, check mark that we took out, like I said, the recent low, and a check mark that we had so far an impulsive break. See this red candle here? That was the impulsive breakdown. Now, remember, I like to say we all see what we want to see in life and in the markets, and I try to do my best to see not only what I see, if I'm making a bearish case, but what might be the other side of that trade, what others might see, or what I should be recognizing. And that is right now, that's what I'm showing you, and this speaks to the whole flexibility thing. Okay, I pointed out divergences yesterday on very much more importantly on the daily time frame, which are still intact, very much intact. Also on the 60-minute chart. So here's those divergences, and they did play out. That little wedge right here, again, 60-minute, played out for a rally of so far about 3.75%. If you trade futures, even a single contract of NQ, I don't have to tell you how much money that puts. Thousands of dollars in your pocket, right? Multiple contracts going to put tens of thousands of dollars in your pocket on just a 3.5% rally. But here's the thing. This is where you gotta be flexible. There are now the divergences that were in place here that led to 3.75 great as an active trader, but as a swing trader, is it worth it? Probably not. It depends on, again, how much you like to go for on your trades. But we have even larger divergence now, and we also have undercut the lows. And as I often say, fewer things in trading and investing are more bearish than more bullish than a failed breakdown, a false sell signal. And that is because when those happen, when you break support, well-watched support level, believe me, every eye in the world, anybody trading, they look at lows. When you break to a new 52-week low on a stock or in the indexes like this, that is bearish. And it's simply bearish because at that point in time, every single, look at it from more of an investment perspective, or trend swing trader investors really, every single person at that point in time holding the cues, holding Apple, Amazon, and assuming they're all also breaking to new lows, is underwater. And so you have a lot of remorseful bag holders at that point in time, people willing to sell, and that sometimes leads to much lower lows, just like in a stock market breakouts, the new highs are bullish. And so, but the one thing about it is you have the divergence here. PPO is wanting to turn up. So here it is. I know I might sound like I'm rambling. My point is be flexible. I took the bear flag breakdown. Why not? It is a bear flag breakdown. As I said yesterday, I was looking for some upside and then another leg down, right? And we pretty much met that minimum target. I'll jump back to it in a second, but QQQ filled most, not all, but most of that first gap. And that's pretty much, and the fact that we reversed hard after that shows me that supply-demand dynamics are actually pretty darn ugly right now still, that there are just not a lot of follow-through buyers on that rally that we had, the Fed rally. A lot of little relief rally that it's out of the way, even though it was the 0.75% hike they gave us instead of the 50 basis points it was originally what we were looking at going into the meeting, but those odds started to ramp up before that. All right, so that's it, guys. And let me just say, so back to that flexibility thing, you decide whether to sit it out. If something doesn't smell right or feel right, don't take a trade. But if you do take it, and you want to be mechanical about it and say, okay, I see a bear flag, I see a previous reaction major low, and I see a breakdown of both, which we have now. Take it, that's great. However, learn to recognize when that might prove to be a false breakdown, aka bear trap, whipsaw, and especially with these 60-minute divergences, it has the potential to be powerful. So it's pretty simple. A stop, I think below the, if we recover that recent low, that might be a little too aggressive. I think above the bear flag is certainly a reasonable stop. Why? Because if we move back up, bear flag patterns consist of three components: an impulsive move down, which is a flagpole, followed by an area of consolidation that takes the form of a flag, followed by an impulsive breakdown and an equally impulsive move that usually mirrors the impulsive move down there. So if you do this, and you take back the flag, you've now foiled it. It doesn't mean that you can't do that and then have the flag play out. All it means is that's just no longer a clean, clear flag pattern. You foiled the flag, and you've also recovered that low, and you're also helping to turn up this PPO, which may firm up that bullish divergence. And should that happen, then again, you have the potential for a bear trap there, meaning a lot of people that shorted and are going to cover. I'd rather be covering quick, and then if it goes back down again, in and out. So I can just tell you, if you look at my trade plotter, history, it's in out, in out, in out in a volatile market, and I don't care. I'm not going to sit tight. Realize that I was wrong, but I'm just going to hope that maybe this is a whipsaw because we just had one here. That's it, guys. I'm just trying to say react, and then more so look at the bigger picture. I might be willing to give it a little more room, but with these divergences, that's pretty powerful stuff. Now, like I always say, divergences are not, and I repeat, they're not buy or sell signals. They're merely an indication a trend reversal is likely. These divergences are still not even confirmed. Confirmed would be a bullish crossover in the PPO that occurs at a higher level than that previous bullish crossover. And so we can keep going down here. And now we also have to remember, look at the bigger picture. So I've just spent the beginning part of this video living in this world of the 60-minute charts. Bigger picture is this: PPOs in bearish territory here on the daily chart. We just took out the recent lows. We had a rally, partial backfill of that gap. That box should be a little bit lower if you look at it there was the top of the gap right there. So either way, yeah, you can see pretty much mostly, but it couldn't even make a full backfill. And that in itself, guys, is pretty weak. That the buyers, the sellers stepped in very early. People who were in Apple, whether they were longs and remorseful, took the first little rally they could get to get out because they're feeling pain. We recovered the lows. This was right here yesterday, even though, and again, it was post-Fed noise, so you have to take that with a big grain of salt. I probably should have impressed upon that even more than I did, but don't read too much into the initial reaction, and that includes not just the pop after the first 30 seconds. The initial reaction is a couple days after the Fed meeting, and then the market will pick its direction. So anywho, that's what we have now, and that's it. Let's keep it simple. We just took out the recent lows. We took out a bear flag on the 60-minute chart. If we recover those, there's still the potential to firm up the divergences. You have potential divergence here on the daily chart of QQQ. The way I'm looking at it, it'd be a little cleaner to get another thrust down. And then the other end of it is, do you want to be short here? Because I've talked about this, the risk reward. And this is just an assumption, if we're only going to go, if we even hit it, my first or next target T3 around 268.30ish or 268ish in the trend line there, the downside's not that much. However, there's no guarantee there. This could, I gave you, and I'll stand by these odds that I gave you before the Fed meeting, 40% chance that we'd hit that level or that one, and those are almost equal odds. So one strategy, and again, the whole takeaway of this video, it's been a little different, is giving you strategy. As a swing trader, if you're short, you can set your stops and just let it run and periodically lower them. Probably get a reaction there, but I'm going to tell you this right now. I'm going to put lower odds on a reaction on this next target than I usually do. So if we get down there, we could start to see just one more wave of waterfall selling that takes us through. So one strategy, and again, you're going to have to use relatively loose stops, or you're going to get stopped out in the gyrations. But if we start to get some waterfall selling, that's when sometimes you don't get those counter trend bounces until you hit that level there. So, you know, you can set a stop and periodically ratchet it down if you start to go down to those levels, and that'll keep you in the game and allow you to, you know, swing for the prize, you know, the big prize, my final target, if it's going to be hit now. And again, I want to just reiterate, these are my kind of what I, you know, little semantics here again, you got to be specific on the words. My final near-term targets, these are trend targets for the first leg down and what I believe will prove to be a much larger bear market, but one that I think if when we get there, you're going to be looking at a multi-month rally, potential for a multi-month rally measured in well into the double digits. So, you know, it'd be a point where I'd look for swing and trend positions on longs. Okay, so we'll see. First things first, we're going to get there and, you know, see what happens today. Okay, I talked about position sizing, flexibility, and we'll just end this video with diversification. Yeah, and on position sizing, you know, I've made it clear lately that one of my favorite, or my actual favorite short sector, you know, for many months now, since back in November, around the time, and every point thereafter, made it clear the Qs, QQQ, you know, the tech stocks and tech indexes, as well as the small caps, were my primary shorting op. And then lately it was about here when we hit those targets. You know, I said I favored the Qs, well, actually on the bounce over the small caps, but small caps have also broken, now broken my second target. See, they've clearly taken out, they bounce, and so that's going to open the door. Potential T3 is now T3. We've already taken out T2, so that becomes now my next target down there, 158.86. But I like the Qs, but I really like energy at this point in time, and you know, have them both. Just a quick update there. XLE, that's a weekly chart. Let me just go to the daily chart. T1 was hit way back here, bounce. That was our most recent sell signal, the break of that wedge. We hit that level. Told you that day you could cover there, trade a bounce, probably get a reaction because there's a quick move down, and then a perfect, look at that. Here's where traders look at these gaps. There's a big old gap right there. We entered the gap, went about halfway through, and then boom, there's your next sell signal. So this is playing out. It couldn't be playing out any better. Initial tag of that trend line, got a reaction like I expected, but also I expected that to, you know, just be a bounceable trade, get and then go on with a breakdown there, and that's what's happened. So just since this signal, not even, what is it, just over a week ago, XLE is down about 13.5%. I also said, you know, if my call's right on the energy sector, you're going to make more money going with XOP than XLE, and that's down since the breakdown here about what am I measuring? 14.83. It's close to it, but and then I finally said XES will give you the most juice, and that is down about 20% right there. I also said you can use DRIP, which is the 2-time for XOP, and that obviously gave you more juice. And this is where, remember guys, I talk about this, if you're going to use leverage ETFs, you want to try to get them when there's a crowded trade and a rush for the exits, or in a correction, or in a rally, a powerful breakout, and what I call a unidirectional trend. See XOP drip right here with all these green candles? This is a daily chart. 1, 2, 3, 4, 5, 6, 7 days of drip going up, meaning XOP went down. And watch this. So I do this all the time. The high from the low to the high, that's about a 40. It is exactly a, let me snap up, make sure I snapped on it. That is exactly a 42.46% rally, so 42.5%. So by that logic, you would think that XOP is down 21. But if I grab that here, from the very top, XOP is only down 17. So my point is, as I often talk about, leverage ETFs. They are the media just tears them apart. You know, they're trying to get those removed because they say they're such bad instruments. People lose money. You lose money if you sit and hold them for a long time, or if you hold them during a choppy period. I've talked about this 100 times. It's on the FAQ page under ETF related questions. you will actually do better than the leverage factor, 200 or 300%, if your timing is good and you can predict these crowded rush for the exits and get these, because that leverage then works not against you but in your favor. So that's why I'm a big fan, but you need to use them judiciously, and sometimes I don't always get it right, but I try to predict when you're going to get those powerful, rush for the exits. And so far, so good on the energy sector. Let's not spend much more time on that. Of course, the pure plays are crude or natural gas themselves. USO is the ETF. Breakdown, back test, just looking good, not even close still to getting halfway there to my first target, the uptrend line in 82.32. Or you trade crude futures. Right here, make sure that's the right contract. Oh, well, we have a turnaround today because we just went and hit top of my third target zone. Remember, I always say cover a hair. These are actual support levels. You always want to cover a hair below it, and that's it. So that is now, so T3 has been, the top of the zone's been hit. I'll fix that later. And there's your reaction. So this is swing trading right here. And this is how an active trader will use multiple targets. Color that up. There was a breakdown there, went down here. That was T1. I believe that's when it was hit. If I remember right, this chart was laid out on this for a break of this wedge here. We hit T1 to the button right there, almost a perfect tag. So undercut it by a slight hair, had the initial reaction as expected. That reaction took us to a marginal, ever so slight higher high, but all it did, as pointed out at the time, extended the divergence and gave us even larger negative divergence. And then we went down, we had one more reaction on there, and then boom, we hit T2 almost to the button. Had a bounce. You could have gamed that bounce, covered your short, and then we went back to T1. Remember, support once broken right here becomes resistance. They stepped in a little early, and there's my example why you always want to, especially in a downtrend, don't try to squeeze out the last few pennies of a bounce. If you're going to plan to short a bounce back to T1 resistance, which was 115, so step in a little early, because that's what a lot of sellers will do. And whether they're longs that got trapped into the crude trade, buying the highs, or they're short sellers looking to get in. And then boom, same thing. You don't hold out. If my top of the line's at 110.16, you don't cover at 110.16. You cover a little bit above it, and that's what happened there. And then boom, a bounce. And so now you have a potential trend line right here. Rough. It's not perfect, but we'll give it that, and we'll see if that checks this route. I don't think it's over. I don't see enough in the chart, so it's a shortable bounce. We're up. We just went positive. We were down pretty good earlier today. We just went positive. So any bounce, at this point in time, right now, up about 0.25% on crude futures. If we bounce back to 115, still objective. If we back tested this trend line all the way up here, that'd still be an objective short. Okay, let me just move on and wrap it up here with natural gas. Got this one out to you yesterday. I told you it would be, to me, a golden shorting op if we bounce back to that level. It was big support for me, and it was big resistance, and so got that out to you. And so far, a nice reversal. Hard to see. There it is. You can see on that little candle. You have to go down to a 1 minute chart, and you can really see from today. Go to 1 minute, and you can see the nice little, look at that. That's where the seller stepped in so far. And trade short term, the same technicals work on the short term charts as they do on the long term charts. You had negative divergence on this bounce that we had back to resistance on that 1 minute chart, and now that divergence is playing out. So there was your entry posted this morning, and you're good for, if it was, first initial position, already positive by about 2%, 2.25%. And then let's wrap this up with the coal stocks, which I told you was my pretty much, I love them all, but one of my favorites. Coal, I'm just going to rifle through the names. I gave you my top picks was about 10 or about a dozen or so stocks. Told you way to take it is a shotgun approach, diversify, because to the best of my knowledge there's not a coal sector ETF, and also enter those tactically. Tactically means on breaks of support or wherever else. So Arch is still got plenty of meat on the bone. This one hasn't really buckled yet. You need to take out this level right here, that bottom line. I have a support zone 150.26, so we'll call that 150.25, and then that trend line is going to be your target there. That's just the sector right here, and you can see the sector, it gave me a sell signal. We had made a slightly higher high, marginal new high, breakdown, and plenty of downside left in the sector, in my opinion. HNRG still up near the highs, hanging in there, but we have a lot of others. AMR playing out nice, breakdown, as I believe highlighted the other day, back test from below, little flagon-ish type action, but we're also below that. See that yellow line right here? 50-day moving average does a good job of acting as support when you're above it and resistance when you're below it, and you took it out, you're below, so you can short it right here at resistance. You could also short a back test of the trend line if we get that. Minimum target's going to be this yellow long-term uptrend line right there. And then before all said and done, if you want to hold out for the prize, which is my preference with these guys, just so tight, this is where we're going, I think, $72. So you still have, to this point, on this one about another 53%, 52% downside if my targets hit, which would also give you about 55, better than 55% on the entire trade if you took it on the breakdown. CEIX, beautiful, same thing. Breakdown, see this one? See these stocks like this 50-day. There was the last tag, 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 tag. We broke it, and when we broke it, look at the big red candle. They came back, they tried to regain it, little briefly did, but then failed it, then regained it and held it. So it likes that 50. So there's your sell signal, just below the recent lows. Keep it very simple. Just put a price alert there, or a price alert below the 50-day. And the redder the better is what I like to say. So if it's intraday, the redder the better, because if you're down here at 1 p.m. or 2 p.m., it's unlikely you're going to recover that level on a closing basis. So that's it. You had a gap down. Target, minimum target, $36 right there. Current preferred swing target, $36. BTU, told you on this one you had a potential head and shoulders pattern with a left shoulder, head, right shoulder. You can short the right shoulder and, partial position. There's your head. I'm sorry, left shoulder, head, right shoulder, short it here. And you want to see, which we've seen so far, you want to see a pretty impulsive move down to the neckline there, and then when it breaks the neckline, which is around 19, that would take you down. This is the measured target for the pattern. I think we'll probably come all the way down here to 954 before all said and done in BTU. METC breakdown backtest was the most recent objective shorting entry. The next one will be, and I'm going to put a price alert here, 1324. When that's taken out, next stop will be 1090, and then 965. And if things get ugly, may go all the way down here to 621. NRP, I love these things. I know I sound like a geek when I look at the charts, but look at that nice, clean, well-defined trend line. Big negative divergences, everybody foaming at the mouth bullish in the energy sector, rightfully so back here, which by the way, you can go on the site. This is where I was bullish on all these stocks back. I did a video, covered them in October, pointed out all these trend lines, bullish positive divergences, and that was the spark of the, this whole trend up. Fortunately, I didn't milk the whole thing, but there were a lot of trade setups and all the same stocks I'm covering now laid out back then. Boom, boom. Took out. See, here's an example where you had just a brief stay, brief little hiccup at the first target there, 40.10. Took it out and headed down to the next targets, 35 and the uptrend line. They come in roughly together. ARLP ready to crack, hasn't done so yet, so there's one. And if it takes out today's lows, because it briefly dipped below the blue uptrend line, we're on it right now. So when that happens, you break down, recover. If you go down again and you take out today's lows, so you could set a price alert right there. Here, I'll do it right now. Set alert right at the low, and if that's taken out, then that'll be your sell signal. Boom, boom, done. All right, CNX, bearish engulfing candle. Where was it? 531. Not seeing it here. Oh yeah, 531 back there. But again, that didn't prove to be the top, so I'm going to take that away. But we topped right after that. And this is an example too about being flexible and persistent. Staying on a trade. At that point in time, I told you there was building. We needed to see a little more evidence. Since then, since the video was done back then, we've gotten a lot of check marks. Check marks are breaks of downtrend lines. So we have enough of these stocks already breaking down. The majority of these are broken down, and the ones that haven't, I just highlighted for you. So those have probably more meat on the bone. There's an impulse. Actually, this whole thing is an impulsive move down. Look at this right here. Boom, little flagging action. So if that breaks, that could take us right through. The uptrend line is my first and next target there, but we could go right on through there and head all the way down to that $16 final target right there on CNX. So give it, I'm going to put in one other target here. I do see some reactions there, and that would come in closer to the flag, 1676. SXC, SunCoke Energy, just beautiful. Clean trendline break, impulsive, everything you want to see. Then I highlighted this little channel here recently and said a sell signal would come on a break of that. We took that out. Even since that, if you didn't get any of these earlier trades, you took that one, you're still up 12. This thing's dropped over 12% since then, and I don't see it, slowing down until it hits at least a 650 target, and quite possibly that 592. NC, one of my favorite. I think I was doing a video when this gave a signal, and I told you I shorted that one. It's already down 22% in just a matter of a couple weeks, consolidating on this 44.79 target, and most likely going to continue on down, whether we get a tradable bounce or not. 38.75, and then the uptrend line. See this uptrend line? This is where I think these guys are coming to. It's just a matter of how we get there. Do we do this? Do we do that? Or do we just remember, crowded rush for the exits can be a powerful thing. And also, this is going to happen only if if crude and natural gas really start moving down here. They're still, the case is there, profitable on those shorts, but they're still resilient. Even that rally I just showed you in crude today off that target, they're not certainly in outright liquidation mode, waterfall selling mode. If that happens, then the crude coal stocks will fall faster. If crude and natural gas continue to kind of chop lower, which they've been doing, then that's probably what you're going to get here with these coal stocks. All right, that one's that Chinese company, so I don't know, they might march to their own drumbeat over there. It's still got a big divergent high, and it'll probably almost certainly buckle with the rest of the group, and you have about 30% to the uptrend line. If so, you just don't have any sell signals, and you get those wonky candles because it is a Chinese company, so it trades, over there, and then it opens up in this market, so it's more thinly traded. All right, I'm going to stop there because those were the ones, that was the last of the ones I had highlighted. These are other coal stocks, but I didn't highlight these as any of my favorites. So we'll wrap the video up here and keep an eye on the market, see where we go. We're still on breakdown mode. They haven't yet managed to foil the breakdown, so like I said, take it on face value. It's breakdown. There's your bear flag. And just keep an eye on things. If they can reverse it, I'm going to put a line right here. This is a line to watch right about there. That was our spike low, but that line I just added, by the way, was at 11. Gosh, these letters are small. 11,289. And I did that because you have two candles there, multiple candlestick shadows and or bodies right there, and then multiple right there at the bottom of the flag. So that's a pretty big level. That's a level, if they ramp it above there, that's probably going to do the trick and give us that little false breakdown where everyone's shorting the obvious bear flag, and then the way the markets do, they like trickery. So for right now, that hasn't happened. So this says this is the most probable scenario. But again, as I covered in the video, be adaptive, flexible, and react to any changes in the charts. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.